My answers for Robbins.
For Robbins?
Robbins.
For Christopher?
Yes.
All right.
Was 1117 for the federal
Mm-hmm.
and 898 for the state.
Perfect.
Oh.
Yep.
All right.
You did good on that one. How'd you do with the $4,000 contribution?
On that one?
There was a bullet point. They made a.
Yeah. What did I do with that?
Did you? It was kind of. It's probably kind of an early one because we really should do that in adjustments to income.
Should go down there.
Mm-hmm.
Yeah, it didn't come up. Oh, IRA deduction. That was one of the questions I had on that.
Okay.
Is the IRA worksheet isn't flowing to the 1040 and states non-deductible.
Okay. So the 4,000 that they contributed.
I made a note of that. That was my question for you on that. Because they have 4,000, they each contributed 4,000 to their traditional IRA.
Mm-hmm.
That should be good because they both made enough money.
Okay.
They definitely both made enough money to put in $4,000 a piece.
Mm-hmm.
When I did the worksheet on it, it did not flow the 1040 because on the worksheet it states non-deductible.
Yep. Because if it's a traditional IRA, married filing joint phases out at 119,000.
That's it. Okay.
So it's one of those things sometimes when you're doing the worksheet, and it's great to explain to the client that, hey, yes, you can do this, but there's no benefit for you right now. So the advice to them should be, you're not getting your bang for your buck here because it's not coming off your taxable or your adjusted gross income. You need to add more because on their W-2s,
You need to add more to the IRA.
the employer one.
Oh.
Right now, they're, Elaine was doing $3,495 contribution, and Christopher is doing $4,690. So, their box one taxable wages that come to the return, there's no way to adjust them on the return with that IRA deduction. What they need to do is if they want to do something like that, and their salary is that high because of the phase out, you want to tell them you need to contribute more through your employer, not try to do it on the tax return.
Like the 401k.
Exactly, because that's what they're participating in there, that D code that's on there.
Yeah.
So their income's too high for the savers credit, and their income's too high to get the benefit of a traditional IRA.
And 401k, you can't deduct it.
Can't deduct on the, what's in the D box, 12?
No, you can't deduct it on the 401, the 1040 page 1.
No.
Does not come out as a 401k.
Nope.
Only the simple and qualified plans.
Yep. And again,
In the IRA.
that's where that's adjustments on the tax return. In this case, their box one has been reduced, or their taxable income that's coming from their W-2s.
Yes, I see that.
And so they have up to 18,000. I think it's going to 19 that they can contribute. So if they want to do that 4,000 a piece, they need to up their contributions through their employer to a 401k, and which probably is a good idea because there may be matching involved.
Right.
So that's a better bang for their buck because with their higher income, they're not going to get anything on the tax return. Okay.
Okay. The next one was we did it. Now Tina White.
And the last one was
Tina White on that.
Ike and Tina.
I can see it, yeah.
Bullet point wise, they really didn't have anything, pretty straightforward there.
Right. So, okay, mine was a refund of 2903 and state 577.
Yep. 2 for 2. Good. Okay. All right. Like I said, the capital gains, that chapter had an awful lot about some of the other things that we will come back to, with business with Schedule C and with rental Schedule E. Okay. All right. What about the exercises? We had some exercises in there. Did you have some questions on those?
And then on 8,
Yeah, chapter 8. There was A where you had to kind of determine the basis. Those are pretty good ones. We should go through those. So let's see, we're on page 8 and 9.
right,
So we had some good ones there. The first one, Dale bought a land and building for $60,000 for use as a parking lot. He paid $7,000 to have a building demolished. Dale received $1,500 for granting an easement through his land. He paid $11,000 to lay down asphalt for the lot. What was Dale's basis in the parking lot at the date of sale?
I did receive the 76,500, so
Mm-hmm.
I did get that.
Yep. Because
I added the demolition, but then I subtracted out the grant and the asphalt.
Mm-hmm. Yep. And then 2, Christy traded in her personal car with a just base of $12,000 for a new car costing $28,000. The dealer allowed $9,000, the car's fair market value for the old car, and Christy paid $19,000 in cash. What is Christy's basis in the new car?
Right, it doesn't really matter, still just for 28,000.
Mm-hmm.
That's what the car costs.
Yep.
Doesn't matter who gave money to whatever, right, just subtract it out.
Yeah. Yep.
Okay.
3, Larry purchased Boston Celtics stock for $6,000 from his brother Kevin. Kevin had a basis in the stock of $10,000 but could not recognize his loss on the sale. Larry later sold the stock for $12,000. How much gain must Larry recognize on the sale?
I put the 6,000 because we don't care about what Kevin did.
Mm-hmm.
We just care about what Larry did at that point.
Yep. Okay. And the last one, Paul purchased a building for $40,000 in cash and assumed an existing mortgage of $25,000. His basis in the property is $65,000.
I say true.
Yes. Yep. Okay.
Because of the existing mortgage we did.
Yep.
Because
Yep.
he had to move it to 1.5.
Let's see here. Another good one was 8C, which is on page page 822. Had some stuff about sale of a personal residence. Okay. If the taxpayer sold their primary residence in 2017, they may be able to exclude from any income and gain up to $250,000, $500,000 on a joint. So we got to answer these true or false. What'd you get for 1? David and Janet sold their primary residence.
I have false because it was only 425 was the bottom part of it. So it's lower than the 500.
Yep. Okay. Even if the gain from the sale of a primary residence can be excluded, the sale must still be reported on Form 8949 and Schedule D.
So no,
Okay. Yep.
need the Form 1099-S.
Yep. For sale. All right. Most property owned and used for personal purposes, pleasure, or investment is a capital asset, i.e. home furniture. Yep. Okay. And 4, while a home and mobile home both qualify for an exclusion of gain, a houseboat does not.
False.
Yep. And then what are the 2 tests required to claim the exclusion of gain from the sale of a primary residence?
Well, the ownership,
And that is?
2 out of 5 years,
Yep. And what's the other one?
and the residence or use. Lived at least 2 years out of 5, so you have to live in there.
Exactly. All right.
You have to own it and live in it. Same thing.
Yes. Which makes sense
Yeah, why did you say you have to make it one? Own and live in 2 out of 5 years.
because it wouldn't be a test. Then it'd only be a statement.
Oh.
Tests have more than one thing.
Yeah.
I don't know.
Oh.
So.
I believe you.
All right. Let's go to the quiz
Okay.
on chapter 8. A lot of longhand forms that doing.
Pages on every single one of them.
Yeah, and that's the, that obviously is the nice thing about the software is that we have the the 8949s are automatically generated. But the big thing taking it away from when you're doing these problems is you understand where it goes where and categorizing with your A, B, C, D, E, F. Making sure you understand that you have a 1099B with a basis, or you don't, or you have something that is not reported in a 1099B. Just understanding what each one of those forms that how it flows away from the Schedule D and then comes back to be summarized on the Schedule D. And it seems like a lot of work, but again, like I said, when the stock market, did all that stuff and the crash, and what they realized that all the brokerage houses, how they were not keeping records the way they should, on the tax return, it forced the hand, because now everybody needs this. So, all right. Name 3 ways to determine the basis of property.
The cost basis, adjusted basis, and basis other than cost.
Okay. 5 examples of capital assets. Could be just about anything. So, 3, we have the form that a broker uses to report the sale of stock.
1099.
Exactly. Okay. And like I said, those have really gotten pretty in depth because they're categorized, and I gave you guys those examples.
Right, because you said we really won't receive a 1099. They're going to have it more involved. 1099.
Yeah, it's just like that thing I gave you as a handout.
Right.
It has, each stock transaction, as long as you use the 8453 that I showed you, that summary, see attached form that you can check on the top of the Schedule D, or the Schedule D there.
The
8453, yeah. That's kind of that see attached sheet. So, okay. Let's see. What are 2 things that must be true in order for a non-business bad debt to be deductible?
A taxpayer must have a basis in the debt, and the debt is totally worthless.
Yep. Got to have some skin in the game, right? All right. What are the 2 tests that must be met in order for a taxpayer to exclude a gain on the sale of his home?
Ownership and residency.
Yep.
Again, the 2 out of the 5.
Yep, exactly. The maximum amounts, what are those maximum amounts that are excludable?
250,000, 500,000 joint.
Okay, and that's the price of the home, correct?
What do you mean that's the price of the home?
So if I sell a house,
Subtract it off the home. If the home was what, 300,000 and you subtracted 250, that's 1,000.
okay. So it's the gain, not the sale price.
The gain.
Yeah, so it's a gain. Some people get caught up in the fact that it's the, they'll get mixed up and think that the 250,000 is what they sell the home for, and it's the gain on the home. You have to take what you sold it for and subtract your basis.
Correct.
And if that's greater than 250,000 single or 500,000 joint, then you have capital gains. 7 talks about if there's a taxable gain on the sale of a main home that cannot be excluded, it should be reported on
Form 8949 and a Schedule D.
Yeah, and again, you had some of those within the exercises that you did in Chapter 8, and they just want to make sure you understand how things flow away from the Schedule D to the forms and way back. With the software, we have the luxury of that capital gains worksheet, where we can just put everything on one spot and categorize it, and then it shoots off to where it needs to go. So, let's see, 8, we had, if the taxpayer has a taxable gain on depreciable property or property used for business, the gain must be reported on Form
4797.
And again, we'll see more of that when we get into things that we're doing in Schedule C and Schedule E, where we depreciate something, and I'll show you, because there's, how the calculation works when you go to sell it. So, what is the difference between a short-term gain or loss and a long-term gain or loss?
The holding time?
Yep.
And then the tax difference.
Exactly. Okay. How much capital loss can we take per year?
3,000.
Perfect. And the rates are there. I won't go through all those, but that's all the rates that you have on that. And how many years can I take a capital loss?
Indefinitely, unless you die. 'Cause you can't, if we do filing separately, my husband and myself, and he dies, I can't assume the rest of his loss because we've been doing it separate.
Yes.
Even
Yep.
though we're married.
Yep.
Right.
Yep.
So he doesn't need to do that.
Yep. So, all right. If he passes and you inherit things from him, what's your basis?
Whatever's brought over from the inheritance.
Okay.
My base.
But how is the basis determined? So if he has stock in his name,
Right.
and he passes and you are the beneficiary or you inherit it, when you're given that stock, what's the basis?
It'd be the basis that day that I get it, isn't it?
Yeah, the day he passes.
Right.
Yeah. Yep.
Or when you pass it, right?
Yep.
It's not legally when it turns over, it's when he dies that I would take over.
Yep, exactly. Okay. All right, so that's chapter 8. Like I said, there's a lot of stuff that was in there that we're going to come back to when we get into Schedule C and Schedule E with the depreciated assets and things like that for business and property use of homes and stuff like that. Okay. All right, so we're going to jump into chapter 9. Okay. And chapter 9 is going to be all about retirements, pension, annuities, and Social Security. How'd you do reading this?
I have my little bullet points.
Okay. Did the railroad stuff throw you for a curve?
The railroad, it just seems like there's just two of them, the tier 1 and the tier 2.
Mm-hmm. Yeah, somewhere along the line, you
It's
know.
like government. When I worked for government, we were either in a tier 1, tier 2, or whatever with our Social Security, whether we paid into it or we didn't pay into it.
Mm-hmm.
So
Yep.
we had a different retirement plan.
Yeah.
And that's how I was trying to figure it out, is what I had.
Yep. Hopefully I got some good clues for you how to handle it. But
Do you get a lot of that though?
it depends. It depends. I have several clients that have followed me. When I was up here, I got a lot. And when I was out in Akron, I really got a lot. But with the retirement and with the railroad retirement, there's quite a few. I don't see as many new clients with it coming in to see us at the corporate office in the city. And, but some of the other offices might, the ones that are towards the area down towards like the grain mills and stuff, there might be, railroad workers that have retired in that area. So. All right, so we're going to talk about taxability of pensions, annuities, and IRAs, and other retirement accounts. We're going to talk about taxable and non-taxable portion of Social Security and railroad. Talk about distributions from retirement plans or IRAs. We'll talk a little bit about how rollovers are handled and how we enter taxable and non-taxable things that carry over to the 1040. Okay. Retirement plans. Here's those terms again, qualified and non-qualified. We've had qualified children. We've had qualified education expenses. So now we have qualified retirement, okay? Qualified is used to describe both retirement plans and other investments. From a non-technical standpoint, which I don't know why you'd have to make that statement, but from a non-technical standpoint, a qualified plan or investment is one funded with pre-tax dollars, okay? That means you never paid tax on that money that went into it, okay? And we were talking about the problem from Chapter 8, the 4,000, because, it didn't help them because they were in a phase out for the retirement. That's where they can do themselves better if they want to put that amount of money, is to up their contributions to their retirement plans through work, because then the number that comes to us on the W-2 is less.
If they filed separately, the one was only 50-some thousand.
Mm-hmm.
That one could have done.
If they're doing married filing separate, it phases out at 10,000.
Oh, at 10,000.
Mm-hmm. Yeah, like I said, you got to be careful, because a lot of people think that, married filing separate will get them, because it'll lower income on each side of the ledger, that it'll allow them to do more. Retirement's one of those. What's that?
What is single?
Single is phases out at 72,000.
I don't understand the single or the filing separately. You think it would be half?
There again, that's kind of the penalty that comes into play with the married filing separate. So, okay. Qualified plans are tax deferred. It's hard to determine which is better. Something that is a Roth that you pay tax on the way in, that's tax-free. Tax deferred, the thought process is that when you go to take the disbursements when you're retired, that your tax bracket's going to be less. So, it all depends. That's a lot of unknown on that. So, all right. The other thing that is in there is RMDs. RMDs is when a taxpayer reaches ages 70 and a half and they are required to take money out. Okay. The RMD April 1st is in the year that they turn 70 and a half, they have till April 1st. Otherwise, they must take it by the 31st. Okay. And then there's the 59 and a half age that, you cannot take money out of a qualified plan until you reach 59 and a half. And not only is it taxable, but there is also a 10% penalty. We'll talk about those later, and I'll talk about there are exclusions that you can get that 10% penalty taken away on a Form 5329.
Let's say you had 3 retirements, 3 IRAs, 3 separate accounts in different areas, and you become 70 and a half. Do you take a portion out of each one that you have to take?
You don't have to. You just have to take what is your RMD. There's a calculator that you basically, the December 31st value of the previous year is what you use for your calculation. So if I have one that's earning 1%, one that's earning 5%, one that's earning 10%, where am I going to take it from? One,
1%.
yeah, because this one has then I leave a bigger sum in my 10% and 5 to do that. Yes. So, okay. Non-qualified on the top of page 9.5 is also used to describe both retirement and other investments. A non-qualified plan investment is generally one funded with after-tax dollars. This means the investment dollars have already been taxed. Again, we think of the Roth that we have on there. Okay. One exception talks about, there's that term generally. So that means the first 9 rules are set in stone, but when you get to Rule 10, it makes 1 through 9 void. One exception is the 457 deferred comp plan. It's a non-qualified plan, yet taxes are not paid prior to investment. Okay. It's a tax deferred. We were talking about government employees. We see deferred comp a lot. I see a lot of deferred comp with up here. I used to do a lot of the, and I had one young lady that worked for me. A lot of the prison guards do deferred comp. A lot of law enforcement, things like that, to keep their taxable income down, they take deferred comp, and where they're going to get some of their pay at a later date. Okay. Our 1099-R is our form that we will see everything on. You're going to start to see a lot of those through your problems through the remainder. Okay. It talks about the pensions and annuities and 403Bs, IRAs. Again, we just have to kind of make sure we understand their classification between qualified and non-qualified. Okay. I don't expect you to be a financial planner by the end of this chapter and know which one is the best and which one has better things. We're just looking at it from a perspective of what happens to it when it comes to tax time. Did they take money out? Did they contribute? Are they required to take money out? Did they take money out too early? That's where we get into the, really what we have to know for tax purposes. Okay. Let's see here. Don't worry about the tax, pensions, and annuities. Okay. All right. It talks a little bit about partially taxable payments. Some of that has to do with what made up the money that's in the fund. On the bottom of 9.7, it talks about that where, we have to know, when we have a distribution, we have to know how the retirement account was funded, because if it was funded with tax dollars, really the only thing we have to worry about is what? Any growth is the taxable, because then it would be tax deferred on that. You see that a lot with annuities. A lot of times annuities are opened with taxed dollars, and you're really only subject to the interest or the growth on annuities. So, it's not like it's, you have to pay tax on when it take the money out of the annuity. You got to remember that annuity may have been opened with money that was already taxed. So
it comes out with a figure. Do you have to subtract something off of that then? Or will it already be done on that point? That
1099-R should have that done. We'll see a method that we use a little bit of. Most of them don't even exist anymore, but there is a method that you can use if the taxable amount is not determined, and you can try to do that. We still see that sometimes with government pensions because they won't have a taxable amount in there and what box is checked. Okay. That's where we'll get into the simplified method. And again, I'll show you that when we get on to the returns. Okay. All right. There's a little example there, and that simplified method, the calculation there, just kind of understand how that works. Basically, if the 1099-R, we're on an example page 9.9, there's that little simplified method worksheet. Basically what that is that if the 1099-R comes to you and the box with the taxable amount is empty and the box is checked for taxable amount not determined, you basically have to do a little calculation to determine what amount of that is taxable. So you pull this information that you have from things that you know. There may be something on the 1099-R that we'll see when it's in action that allows us to do this calculation to say, well, yes, he took out 31,000, but really only 29,800 is taxable. Okay.
And what happens if they don't have any of this information?
They will, and again, each year that goes by, you see fewer and fewer of these because everything, with the basis of stuff and keeping records of all these things, a lot more of it is more kept track of. Okay. Lump sum distributions talks about that. Okay, disability pensions. We'll talk a little bit more about these. There is on the middle of the page, talks about the rollovers from a qualified retirement plan. So we're kind of in the middle of 9/11. Talks about rollovers from a qualified plan occurs when cash or other assets withdrawn from one qualified retirement plan are contributed within 60 days to another qualified retirement plan or a traditional Roth IRA. For full rollover options, see the chart on page 916. The rollover traction is not taxable, but is reportable. Okay, and we get a lot of letters about that where somebody will say, hey, how come you didn't report this 157,000? Well, it may not have generated a tax form, and we'll talk about the codes that are on 1099-Rs. It may just be a form that shows a distribution, and then you did something within 60 days to make it a rollover. Okay. Most rollovers, though, that we think of are what they call trustee to trustee. Whoever is in charge of the administrator of this account sends it to the administrator of this account. It really never went into my hands. So that's what we think of most rollovers, and those are reported on 1099-Rs correctly. But if I have money that came out of this, they sent a check to me, and then within 60 days, I roll it over. A lot of times then we have to get a document from whoever it went to showing the amount deposited into a qualified account. Then it's classified as rollover. We still have to show that on the return, but the IRS a lot of times will question those, especially if they're a large sum. So
I had a rollover and during the college days of my last daughter. And Canisius took that as income and threw me out of my financial aid for my daughter.
Yeah.
And it was rollover. No matter what I did to prove that it was rollover, it didn't even come to me. It did exactly what you said.
Mm-hmm.
Point A to point B. They left me out. Didn't care.
Yeah. And that's where they pick up on it. And again, when we see the 1040, that indented column, it'll show up in there. So it looks like a number that's there, but you have to understand the fact on how it has to be reported. The IRS requires you to report it, but yeah, if somebody's taking a look at that. So, and that's where when we talk about modified adjusted gross income, there are things in that indented column that we might add back in to get modified adjusted. Rollovers are not one because we never really physically possess that money. The gross of Social Security that we'll talk about later, that would be added to modified adjusted gross income because a lot of times only 85% or less of Social Security is taxable. So, okay. Talks about rollover options there. As we just talked about, a direct rollover, a 60-day rollover, as I talked about it there, you have 60 days to roll it into something else, okay? Let's see here. They have the little, let's see, on page 916, if you go to that, it's a great little chart that's in all the quick finders. That's a great one to have reference to because we look and say, okay, I have a Roth, all right, and I'm going to put it into a traditional. Okay, so basically talks about, you know, can we do it? Well, it says no. Okay, but can I take a traditional and put it into a Roth? Yes, but what do I have to do with it at that time? So if my left column, I'm rolling it from a traditional to a Roth, I have to pay tax on the way in. So it's not like it's a tax-free rollover, because Roth money is what when it's in there? Taxed money. So at that time, that conversion, sometimes they'll call it on that. Okay, but you can see how the different, and it has a lot of footnotes there. You know, what is it, 7 different ones that show, you know, specifically handling of each thing. And again, you know, you got to make sure you're doing apples to apples. You know, in the case of a traditional to a Roth, we're doing an apple to an orange. You know, we're trying to change the apple to an orange, so something's got to happen.
At one point, they allowed it to try to roll some of the stuff over to the Roth.
Again, the conversion, but you know, the premise of the Roth is that that is taxed money, so that conversion is a taxable. And some people think that's a great idea. They're like, well, I'll go ahead and pay tax on it now and not worry about tax later. But again, the conversion has to work because you have to make the assumption that your tax position on that money is better now than it would be when you take it out. You know what I mean? And again, that's the crystal ball that people have to understand. So, okay. Back up on, let's see here. A lot of the rollovers there, it talks about, we went through the example, talks about rollover by surviving spouse. The rollover rules apply as if the surviving spouse were the employee. Rollover by non-spouse beneficiary. The distribution must be a direct trustee-to-trustee transfer to a traditional Roth IRA that was set up to receive the distribution. The receiving plan will be treated as an inherited IRA. Okay? And then, you know, basically, and we'll see this when we talk about some of the New York considerations and things like that, when you are getting that inherited IRA, you get the rules of whoever you inherited the IRA from. So a lot of times it'll be coded 4 for a death benefit. So if I'm under 59 and a half, on the state side, I would get, you know, that person's exclusion if they were over 59 and a half when they passed.
But technically then you can draw from it even though you're under 59 and a half because you're using the
same rules. Yeah. So yep. So you get the same rules, and then you can see, and we'll play with the codes and show how that's handled. Okay. A lot of people, I'm amending actually one for a client that came in yesterday. So I have a feeling he's going to be a new client because whoever the CPA was that did his previous return, he inherited a whole bunch of IRA money and he took it, and you know, I explained to him that it was done correctly on the federal because he was thinking he paid too much tax, and I said no, you know, it just, when you put all of the different ones together from dad, you weren't withholding enough, so you had tax. I said, but on the state side, he cost you about $1,200 to $1,500 because he did not take the exclusion that you inherited from dad with that IRA. So
and then is his basis that day of the death of his father?
Yeah. Yep. So, okay. So we'll talk about that. Let's see, IRAs. It talks about traditional IRAs. You know, it talks about most contributions are deductible, and again, most up to the limit. That's where we talked about that 4,000. There are some phase outs with things like that. RMDs are mandated by the IRS. That's at 70 and a half years old. Okay. And failure to make the RMD results in the excess accumulations tax of 50%. Okay. And I've had clients that this has happened to. I've fought it. I think I've been successful a couple times. One example was a client I had when I was up here in Lockport. For some reason, it was it through Discover? I can't remember who was through. They decided to save money on postage, that if they had a married couple, they would send the RMD letters in one envelope with the 2 letters about the RMD folded together. And so he opened it, didn't look at the second page, and only did his. Older gentleman. So, fought it with the IRS and said, hey, they didn't, disclose this separately to each holder. They put it, two of them in one envelope. And I'm like, okay, we'll let them off. So there are, cases where we can do the RMDs with that. Okay. Early distributions, there are penalties. Like I said, that 10% penalty that they have there. 9 and 14, it talks about Roth IRAs. They're not deductible on the tax return. They grow tax-free. And, typically on distributions, you do not pay tax on them. Okay. Distributions that meets the following requirements. There is a 5-year holding period with the first taxable year for which a contribution was made to a Roth. So you have 5 years that you have to hold that. Okay. So you can't put money into a Roth and then take it out within 5 years. Because some people say, oh, I got some money in there, I can take it out, it's tax-free. There's a holding period. So that might be subject to the 10% penalty for early withdrawal.
However, normal non-qualified, you can.
Take money out if it's your money?
Non-qualified, I threw in $10,000, I already was taxed on it. And in 2 years, my daughter wanted to go to college again. I can just pull that out. If it
qualifies, yes.
Because it's not really a Roth one.
Yeah. So you just have to be careful because, again, that 5-year holding period, you got to make sure because you don't want to pay income tax on it plus the 10%. And that's where when Esther's on the radio and people are talking about, taking money out of their retirement to pay this or that off, it's just a bad idea if you're under 59.5 because you're really getting double taxed on it. You might be in a 15% tax bracket plus an additional 10% penalty. You're really getting zinged on that money. On the federal and on the state too.
I thought on some of them they take it as a loan to pay it back.
Well, that's if you do the loan. That's different. Yep. And people have to be careful with that because if their employment is ended with an employer where they have a loan from a 401k, when their employment ceases, it automatically becomes a distribution. So you have to also now they take in, whatever they still owe would become a distribution and some calculating back to the original loan amount as if it was a normal distribution and not a loan. So, and that's where employers are smart enough that they take in for people that are going to do loans from retirement accounts, they will take and make sure it is a payroll deduction so that they don't miss a payment. If you do it privately with a retirement account and you go and take a loan and you miss a payment, most of the times within the contract, that means you defaulted like any other loan. And what does it happen? That creates a distribution, a taxable event, plus a penalty if you're under 59.5. So, that's where, you really got to make sure that you're, on top of it, however you're doing that. So, okay. Let's see, it talks about the 10% penalties. These are some exceptions that we can get into. It talks about permanent disability. Used to buy or rebuild a first home. Some of it talks about medical expenses that are more than 10% of their gross income, higher education in order to pay off an IRS levy. So, the IRS says, well, yeah, we'll take our money. So we won't penalize you. All right. Great little chart. People always wonder what's the difference between a Roth IRA and designated Roth account. Great little chart from the IRS that kind of talks about those differences. Okay. One big thing that comes in there is if you look, we talked about recharacterization of rolled over amounts. The Roth IRA, you can do that. A designated Roth account, you cannot. Okay. They go back and forth. I think there's been some talk about changing some of those rules coming up. About the recharacterization things. So, all right. Okay, there's that little chart on 916. We talked about IRAs and the rollovers. Reporting the IRA rollover, like you said, you ran into with your college. So we have that. A lot of conversion stuff here. It's good just kind of to read through and how those work.
Oh, this is what I got a question on. Yeah,
Yes.
waiting period between rollovers, it said within 1 year. I thought the rollover had to be within 60 days.
Where are you looking at?
It is on page 917, second one down. After reporting IRA rollover, then it says waiting period between rollovers. Generally, within a 1 year period following the tax-free rollover, any part of the distribution of traditional IRA. That part. Or is it
Oh, it's just
1 year?
basically you can't, within a year's time, well, no, you can't do 2 rollovers within a year from the same IRA.
Oh.
Okay? Yeah, don't get that mixed up with the 60 days. Yeah. Yeah, that probably kind of reads tough, but yes, it's basically, as it says here, is also not allowed to make a tax-free rollover of any amount distributed within the same 1 year period from an IRA which received the tax-free rollover. So basically, it's kind of like we were talking about the Roth with that 5 year. You know, you can't do a lot with the money, you know, if you've rolled it over somehow. So. Okay.
That makes more sense.
Yep.
You can't go from one to the next It's doing it.
Yeah, trying to improve the tax position, stuff like that. Okay, so on the top of page 919, we finally get to this thing that they kept talking about. That's the 1099-R. Has a lot of information on it. You know, these are always the 2 boxes we're worried about. Gross distribution, box 1, and 2A with the taxable amount. This is what I was talking about those taxable amount not determined. This might be checked and this might be blank. Like I said, we see a lot of those on the government. When we get to the software, and we'll talk more about the simplified method, how the calculation works. Total distribution, if you see this check, chances are you're going to see maybe a G here for rollover. We'll talk about the codes that are very important. Talks about if it's an IRA event, okay? And then always, this one kind of hides down here, okay? 12, 13, and 14 talks about state tax withheld. A lot of retirement accounts, when you go to take money out of them, will not do state withholding because the retirement funds do not want to deal with 50 different states doing withholding. They'll do the federal for you and they might mandate 20%, but they will not do the state. So sometimes people have to prepare either with estimated payments or know that they're going to have a balance due at the end of the year because they just won't do state tax deduction.
So then that will be blank, then we can figure that out.
Exactly. You might have to figure out, taking a look at their state return and, you know, depending on what the exclusion was, when we talk about New York State considerations with the first 20,000 being tax-free in the state of New York if you're 59 and a half from a qualified account. You know, in this case, a lot of them, you know, people don't realize, you know, that they, that there's been no state tax. And they go, yeah, I asked for withholding. And I said, well, this is a fund that won't do state withholding. They'll only do the federal and they might mandate 20%. So.
The first 20 is tax-free in New York State.
Mm-hmm. And if it's married filing joint, you each get 20,000, and you can't share your 20,000. So, okay. And we'll talk more about the distribution codes.
That means it's up to 40.
Mm-hmm. Mm-hmm. In fact, if you go to the bottom of 920, there's little instruction things. Has boxes, you know, the codes 1 through 9, then we start into the letters. And then we have some more letters. You know, it's kind of goes through all the different codes that there can be in there. And it doesn't mean the codes necessarily are just one code. Sometimes you'll see, you know, death benefit combined with something else. Or you might see the letter L. You know, you were asking the letter L there on page 921 is loan. You might see an L1, you know, stating that it was a loan distribution and the person was also under 59 and a half so that it has the penalty. So you know how the distribution. So sometimes you'll see it. What's that?
If it's a loan, it will have a penalty or will not.
They will if they're under 59 and a half and they default or lose their employer. Yep. So that's where a lot of times, like I said, you know, when people talk about, well, I'm taking a loan for my 401k to put the new roof on, and I'll say, that's great. I said, are they going to do payroll deduction? Yes. Okay, so that's good. So we don't have to worry about that. I said, just remember that if you part with that company, either the loss of the job or you leave there, you got to be conscious of this, because all of a sudden that could be categorized as a distribution. Then you're on hook for taxes and early withdrawal if you're under 59 and a half.
So how can you prevent that? Can you continue to pay on it, or just no, just a gamble?
Pay it back.
You're afraid that they stay in business.
So if you got a loan of 40,000, you're going to pay it back, so that, you know, put it back in there. So, okay. All right, let's see. Yeah, let's take a break before we get into the railroad. Okay. All right. Yeah, Social Security and the railroad stuff. Let's take a break. Take 5 minutes. Coffee's back there. So, okay. Social Security, something that we all look forward to. All right. You pay into it. You contribute to it. You know, the Social Security Administration takes care of that money that you've paid into, or you might have a disability. Hopefully that when we all get to that age, that there will still be money there and they stop raiding the fund. So,
you need your 40 quarters.
Exactly. You need your 40 quarters. So, just like your Medicare. Railroad workers, they have a little bit of a different system. We'll kind of talk about how that works. Okay. We have this form. 923 is our SSA 1099. Obviously, the number 1099 is pretty common. When we see that number, we know it has to do with something with retirement. 1099Rs are showing us the distributions from those qualified and non-qualified accounts. This 1099 is has our Social Security that we have on there. Okay. The boxes are pretty important. I wish this page was in color, but we're always worried about the pink box, Social Security. So this form is usually pink, and that box number 5 that's shaded gray there, you know, that is a pink box on the actual form. So when people come in, sometimes they'll bring in because they have or misplaced or didn't open it because it looks like one of those junk mail things where you got to tear off the tabs. They'll come in with the letter they got that talks about that their benefit for the upcoming year has increased. You get those about the same time, same form letters, Social Security, you tear off the little things, which I thought was always cruel because, you know, for somebody that's 80 years old and has arthritic hands, getting that envelope open, that's torture.
It's so complicated. I think it's cruel to begin with. When you get 80 years old, you don't want to have to think.
Exactly. But I always have to ask them, nope, I'm looking for the one with the pink box. You know, so that's that benefits, and that's the number that we're going to work off of is that box 5. Okay. Box 3 that's on there talks about the benefits paid in the tax year. Sometimes what'll happen is that somebody, especially on a Social Security disability or something like that, will have the benefits paid for that year, the previous year, maybe 2 years back. If you get a lump sum election, call me and I'll walk you through it. I'm not going to try to explain it to you because it'll kind of cloud things right now that we're talking about between just sorting through a 1099 for Social Security in the pink box and one for railroad retirement. Okay. So don't get caught up in the lump sum election. So we're always worried about box 5 because that is what we're using to figure our Social Security that may be taxable. And then obviously the other one is in box 6. Some people, knowing that they have other retirement income and such, that's where they will do federal withholding. States, I don't know of any state where Social Security is taxable on a state side. Okay.
So the federal will actually withhold from their Social Security
tax dollars. Yep.
tax dollars when they know that they're drawing from another account.
Well, you know, if they have high pensions, prime example, a lot of times state or government pensions are pretty sizable. You know, it's going to make, because of what's on their tax return, it's going to make up to 85% of their Social Security taxable, so they need to have withholding. This is where a lot of times people have gone from, and once they've reached full retirement and they're taking Social Security and their pensions and IRAs are low enough, it doesn't make their Social Security taxable. but then they decide they're going to take $20,000 additional out to buy a new car. Well, that $20,000 all of a sudden may trigger Social Security taxable that had no withholding. So sometimes what we get into is that people don't realize that their income's getting hit twice. And all of a sudden they're generating not only the taxable event of the $20,000, but they're also making some of their Social Security taxable that they had no withholding on. You know, it's odd because Social Security money is already taxed money anyway, and we're paying tax on it again. But yep. Yep. Then in the middle of 924, we have payments by the railroads. Okay. This is the Social Security side of it. The way I always remember this is pink and blue, boys and girls together. Okay. Because Social Security is pink, the railroad is blue. They both go on the Social Security worksheet that we're going to see in the software. So I always tell my students, pink and blue, boys and girls together. Okay. The green, that's the money. Okay. So pink and blue, boys and girls together. So they go on the same worksheet. The boys and girls, the pink and blue ones. Okay. One of the other instructors, I told them that trick. And they looked at me and says, what if you have somebody that has decided to not identify with one gender or the other?
They're pink or blue.
But if they chose not to associate with one or the other, then my whole memory thing is shot. So.
I have near that box 5, I put down add all box 5.
Add all box 5.
I wrote that on there, which means do you get more than one Social Security? Or is that where our pink and blue, where we have to add both the box 5?
Well, they won't get a pink if they get a blue, and vice versa. The pink and blue, the adding all box 5s together, you know, if both is married filing joint and both are getting Social Security.
Yes.
Yeah, and we'll see on the worksheet there is a taxpayer and a spouse thing, but yes, on the return on the 1040, it just shows as it added together. It doesn't distinguish between each one. Just like the retirement, it shows up on that line, but it doesn't distinguish which is taxpayer and which is spouse. But this is an area, retirement is an area that you have to be very conscious and very careful, especially when we talk about New York considerations. You have to be very conscious, very careful to make sure when you put a 1099-R that you get the right taxpayer or spouse. Because when we're talking about exclusions or we're talking about 59.5 for a penalty, you know, you might have one person that's 59 married to somebody that's 61, and if you don't check the correct person based on the birthday you put on the main info, that 61-year-old person, you might generate a tax penalty because it thinks that they're the 59.5 under 59.5 spouse. So you got to be very careful, okay? And especially for the New York side, you each get that 20,000. You got to make sure you separate so that they can maximize it if you need to, okay? There is the, like I said, the retirement one. Pretty much the same. Talks about on 925 to find out whether the taxable benefits are taxable, compare the base amount for the filing status of the total. This little thing that they did right here, this little 1/2 of the benefits plus all that stuff there, that's actually a little worksheet that's on the back of the pink box form. So if you flip it over on the back, there's a little worksheet there that's pretty simple to use, okay? The thing about the base amount, basically, if income received was Social Security or SSEB portion Tier 1 railroad are not taxable and is probably won't necessary to file a return. If there's income in addition to the benefits, this is what I was talking about, may be necessary to file a return even if none of the benefits are taxable. This base amount here, those are kind of the thresholds where once they go past that, it may make some of their Social Security taxable, okay? And
that's normal Social Security, not talking about the railroad.
Well, yeah, same thing. Okay. But, you know, anywhere from 32 to about 44,000, once they go past 44,000 for married filing joint for other things, it can make 85% of their Social Security taxable, okay? And again, when we get into problems, we'll do some what ifs and kind of manipulate that a little bit. All right. Little example there about figuring your taxable benefits. I never give this to anybody to try to calculate that. Like I said, for simplicity purposes, I just tell them to, if they're wondering, in an upcoming year or whatever, that, maybe they just turned full retirement age and they're just starting Social Security right now for 18. And they're wondering if it's going to be, how much of it's going to be taxable in 19. I'll have them use a little sheet on the back, because I'm not going to give them this or walk them through this, because they'll look at me and go, are you crazy? So where did you get these numbers? I made them up. So
when you say 85% of it's taxable, it's after it gets down to the bottom line of it. So 85% of. Yeah.
So, if somebody makes $20,000, 85% of that 20,000 can be taxable if on a married filing joint, that other income on the return is over 44. And we see this a lot when you have people that are maybe farther apart in ages, married filing joint. One is retired and one is still working. So, a lot of fun, right?
Good.
Okay. Taxable, non-taxable. Again, we talked about the little indented. Okay. Now, on 928, we get Form RRB 1099-R. Okay. And again, that's the green form. Like I said, pink and blue, boys and girls together. They're on Social Security. Green, that's the money. So it's going to go just like a retirement account. Okay. So you treat it just like a 1099-R. All right. These are so confusing to start with. And if you see one or two a year, you saw a lot. But you just have to remember where they go to get them on the right spot. So again, when you look at the form at the bottom of 928, it looks a lot more like our 1099-Rs. So we treat it that way. Okay. And I'll have to see, make a note to myself here if I have a piece of paper. I'll have to see, I got a little cheat sheet. It's a little clearer about how to handle the railroad one. So I'll see if I can chase that down. It's like when we get into some special circumstances that I'll talk about how the ministers are treated, and those are really a lot of fun. So I'll make sure I chase that down. Because the minister one I pull out every time, somebody that worked for the IRS that I used to work with up here had made it up, and mine's all yellow and tattered, and I should probably laminate it. But I still pull it out to make sure I don't miss anything, because you just don't do them often enough to do them by memory sometimes. So, okay. So that's the other half of the railroad. We have, we'll talk a little bit more about this when we get in there. Civil service and federal employee benefits. Yeah, kind of what you were talking about. Some of that has to do with, that you don't pay into the Social Security system, so things are funded a little bit different. Some of those people, the other two that I'm fascinated with is that when some people that work for unions, like up here for GM and stuff like that, their pension's higher when they're under full retirement age. Once they start receiving Social Security, their pension is reduced because they're making up for the portion because they're getting Social Security. So there's a lot of those that are in there. So, which is to me fascinating, but I guess that's the way the unions save money. Okay, so that's half. So we're going to do, we're going to get in, we're going to do a couple problems here. Because sometimes it's almost better to see these in motion, and then I can talk about some of the different. Okay, so chapter 9 has a lot at the beginning with the little cheat sheets about help things on where things go. All right. Let's see here. Okay, so let's go through and let's do 9-1. All right. Oops. 9-1, we have Elmer and Elizabeth Jones. Okay. Elmer is a name you don't hear very often anymore, isn't it? All right. Okay. All right, so we're going to do Elmer and Elizabeth. All right, so go ahead and get into your tax-wise and go ahead and start putting in the main info there. Okay. All right, always make sure you get that taxpayer. And again, realize who when you're doing the main info on these and you got somebody that's got retirement, realize who your taxpayer is and realize who your spouse is, okay? All right, Elmer and Elizabeth are on River Oaks Drive. I think that's a real street, isn't it? Grand Island. And if they're pretty savvy people, they're on iCloud. If you want to FaceTime to see all the grandkids. You know, I ended up when my second son, because he was going to study business and he needed it, when he ended up starting college, I went ahead and did that Office 365 where you just subscribe to it and things like that. And we have a terabyte of cloud storage to share. And I didn't realize how much is a terabyte. We've never even put a dent in it, and there's 6 of us sharing it. So. Yeah, you know,
They say I am totally full. Somebody's in Patton sharing.
My mother's a big photography person, and her phone is always full because she's always snapping pictures of the kids and the grandkids and grandchildren. And her phone is always full, and she's just so fearful of the cloud. She's like, well, what if the cloud evaporates? So. All right. And Elmer's retired, but it looks like Elizabeth is kind of semi-retired. She's still got some W-2 income. And we'll do them as married filing joint.
She's not really retired. I'm retired.
I put semi-retired. So.
Oh, I wrote it as retired what?
Yeah.
Or is she retired what? No,
she has a W-2. She's still working.
Yeah, she's not really retired.
And she's 9 years younger than him. So.
That makes sense.
All right. So we have, they live in New York. Talked about on the bullet points that they did a 1040A, so no itemizing. And they'd like their refund deposited. If they owe money, they want to send a check. All right, so we are back. All right. And again, I can't stress enough, you know, I know it seems redundant and you want to get to the problem and learn stuff, but make sure you're completing the main info. Obviously, we get into retirement, and it's important to get the birth dates in there right because of the 59.5 and or 70.5 rules. Mm. Okay. And they had health insurance all year long. And just a few other ones. So go ahead and go through and get everything in, including the W-2, and then I'll stop and we'll work on pensions and talk about some of the stuff and rules and things as we go along. Naughty for you is where she works, huh? When you do the W-2, do me a favor, and I've kind of taught you to delete that 414H SUB in box 14. Leave it in there because we're going to talk about it a little bit. Okay. No. You're slacking. Okay.
Now, when you say about the 1040, that's not really on the main form. That's you go right into that other form. I usually would.
What's that?
When you were saying about, well, they did a 1040A, so they didn't itemize.
No.
They did a 1040A. It's not on the main form to say that, to answer that question.
No, it's but we know then, when we've talked to them or we've looked at the return, we know that the middle of 1040, page 1, we can put that that little box there.
Okay, so now the W-2 is a spouse.
Yep. Nope, I'm watching out there because people are taking down there. I wonder why they haven't done it. The little fish things out by the street are standing out pretty good. We're supposed to have 50-mile-an-hour winds, and I'm watching some of the people.
All right, so let's go back to that 14. I always put that in that when it has the New York State.
Yep, on box 14, but leave the first line. See how I left it in there?
Mine didn't come up as that.
Well, we'll talk about it here in a second. So go ahead and put in your New York State disability on that.
Oh, you put the 1099R.
I haven't put that in yet.
Oh.
So just let me know when you're done with the W-2, and then we're going to do a couple things here.
the W-2 in. Did it just show up, the 414?
It'll default in there because of what you have to do, and we're going to explain that right now. Okay.
Okay.
All right. So this little thing, on some, if you were working for a government pension type thing, you know, say that Nutty for you is working for the governor, and she has this. This is a state pension fund. Okay. And this little code there, what happens with it is that if they contribute to it, we have to override the top. Remember how I showed you to uncheck the boxes? Remember that? Nope. Oh, no, never say F8. I'll take your F8 button away from you if you ever mention it again. Okay. Up here where we have these little boxes, that right now, these boxes, if I try to type into that box, it gives me that it's calculated, correct? Okay. But if I take and I check this box, and again, mine's a different color because so you guys can see it. But if I do that, now I can go in here and I can change that number. Okay. So in this instance, if she had, this is a retirement contribution, it would be like a box D in 12, but it's over here for a state pension. If this number read 1,000, I would then have to add it and adjust up here.
You have to add the 1,000 to that?
Yeah, because you know how it's, you know, it's
income.
It's not taxable on the federal, but it will be taxable on the state. And the reason it is, so if I put in here that I put $1,000, okay?
And that would have been on a 1099-R form?
No, this would have been on the W-2.
Okay.
Okay?
That would have been, oh, so you just did that yourself.
I just making this up.
Okay. Now
If I look right here, public employee 414H retirement contributions from wage and tax statements. So I pay tax, you know, because this is where it's going to talk about, because it's different on the state than it is on the federal. Okay. It goes in tax-free on the federal, but it's taxed on the way in on the state.
And that's because they're federal employees?
Yep, public employees.
Public employees.
Yep.
Which means they could have been hired from the state, so the state still.
Mostly it's a state type thing.
All right, so that means that the state will definitely do the taxes, and federal is saying because you're a state employee, we will not do it.
Exactly. Okay. So as it says down here, though, the thing that's odd about this is that it is called a 414H SUB. Okay. Anything that's coded like that, SUB usually means subtraction. Yeah, subtraction. But it is treated as an addition. And even the software knows, okay? New York has requested a change to the codes used for Form W-2 for this 414H. You must use 414H SUB to indicate additions for this. So they even know New York's got it backwards. Why isn't it called a 414H ED for habit? I don't know. New York has decided to call it an SUB. We see these a lot because a lot of times people will forget to carry this over. And if you just put in a 414H, it won't carry over. It has to be 414H SUB because you have to pay tax. So it's kind of treated like a Roth on the state side. It's treated like a traditional IRA on the federal and treated like a Roth on the state because you have to add it to your income.
And that will flow over to that just as long as you add it to your
414H SUB. As long as I have it.
And you have it as that on the state.
Mm-hmm. Mm-hmm.
As 14.
Yep. So if I go back to that W-2 for Elizabeth, as long as this says 414H SUB, but if I just call it a 414H, which sometimes it'll show up as, it's not there. Okay. So you just have to know that, you know, if you have somebody that's contributing that way. And the reason for it is we're going to talk about in a second about federal pensions from the New York State considerations. It's just the fact that it's there. Okay. And the thing about New York State pensions, they're taxable on the federal, but they are all tax-free on the state. So if I'm a retired state or government employee and I make a $75,000 a year pension, I pay tax on that pension on the federal, but on the state, I pay absolutely nothing. And it's even though it's in excess of the 20,000 exclusion.
Is it because it was already taxed at the state level?
It's just the way the state of New York treats its employees. So, and that's why contributing these 414H is done that way, okay? All right, so let me put my SUV back in there for tonight. Okay, so we have that in there. All right, so let's go to, no, so otherwise your problem will be off from what we're doing. All right, so we have that all in there. Now, I have, at the bottom of 9.7 in the workbook, I have Elmer and his pension. So I'm going to go to 1040, page 1. And I'm going to go down to where my retirement, my pensions, annuities, and such are. Okay, there's a pension line. I can pick either the indented box, whichever one, and I'm going to hit F9. Okay. And it should bring up a little square. Yep, 15 or 16, either one. Okay. And I'll show you why it doesn't matter because we'll show you how it's categorized. So 15 or 16, either one of those indented or the boxes on the right. And I F9, I get a new 1099R. Okay. Now, like I said, this is where it's very important to make sure that you have the taxpayer or the spouse. Okay. Yep, because that number that you put on the main info, because Elmer's how old? Okay, and how old's Elizabeth? Yep.
Lower than 59.
Yep. So
she gets penalized.
Exactly. Okay. So we have that on there. Again, just like W-2s, we're going to check and make sure that the address matches what's on there. We're going to put in the payer ID, again, very similar to what we do with our W-2s. And he is getting this from my pension. Original. Put the address information in there. Okay. And he has a distribution of 15,000. Okay. And taxable amount is all 15,000. All right. And then we look at box 4, and it's, you know, they are bolded like this because those are the main focus boxes. He actually had 10% withheld, so he's got $1,500 withheld. Okay. Now, this little box right here is where our codes are. Remember I showed you there was, what, about 20 codes or more codes? This is where we're going to put that in. This is important that we get it in there correct. Yep. Which is just a normal distribution. Okay. If you want to hit F1, you can go in there and hit F1 and it'll show you all the different codes and give you an explanation if you need to show the client. This little box right here, remember I was saying about it doesn't matter if I get my 1099 off line 15 or 16 with this little box here. If I check that box, it will go on line 15 because that's the IRA distribution. If I don't check it, it goes on my pension annuity line. Okay. So checking that little box after that does, okay. In this case, you know, we have F7, or excuse me, 7 for the code. And yep. And then we look down and we see that there was no state. Okay. Now, this is where we make our determination for New York State. Okay. So if you go down, there's this little box over here to the left that's written in red and has box 1, 2, and 3. Okay. Box 1, you check that if they're 59.5. Is it over 59.5? Well over. So we check that. If this pension was a federal, state, or government pension, I would check box 2. Okay.
So we have to see F1 to make sure we know which one it is.
Well, just remember box 1, 59.5, box 2, 59.5, box 2. Okay.
Box 2
Mm-hmm.
is a federal pension.
Yep. And then I obviously don't worry about box 3. And then you can see, I guess that would be for future use. We have the other one for railroad. Okay, so let's check box 1. That makes them 59.5, okay?
Or older. Right?
Yep. So what I want you to do now is I want you to go to the New York 201, page 2. Okay? All right. See how it part of that exclusion? So I'm subtracting that. He gets up to 20,000 there, okay? Now, there is a little indented box there. So if it is the year that they turn 59.5, they don't necessarily get all the money excluded. Sometimes what will happen is you'll get somebody who will get 2 separate pension things because they started getting their pension before 59.5. And for the New York State side, they might get one that has the first 3 months, then they turn 59.5.
So they're only penalized on 3 months?
Exactly. So they're only, because if you, in the year that you turn 59.5, you got to be very careful because not all the months are excluded.
I'll be 60 in December. I'm golden.
Well, December, so you turn 59.5 when? In June of this year. So if you had money that was taken prior to your 59.5 birthday in the months of January through May, it would not be excluded.
I should have done that, but waited a few months.
Now, because, you know, anything from January through May would not get the 20,000 exclusion. Anything once you turn 59.5 and older, that's when it's excluded. Okay? All right.
And the first 20,000.
First 20,000. Okay?
Both federal and state.
Yep. Now, let's go back to that 1099-R. Okay? So the one for Elmer, we're going to pretend like this was a government pension. Okay? Yep. So I'm going to check box 2 as a government pension. All right?
I'm not doing that. You're just...
Yep, I'm doing that. And I'm going to say that he got $30,000. Okay?
Instead of 15.
Yep. All right. So if I go to the New York 201, page 2, you can see, well, from our knowledge, we know that if it was 20,000, only the first 20,000 is excluded from income. But because he is a New York State local government person, he gets all 30,000 excluded. Doesn't seem fair, does it?
Huh. Do you ever work for the government?
Nope.
Yeah,
Nope. Nope.
I did.
Okay, so that's where we have, you know, that's how we treat that that box down there. And again, have to remember to check it, because right now, if I'm looking at this and I'm working on this form, what's kind of out of sight, out of mind? Yeah, that box where you get that exclusion. Okay.
Plus, if you don't check it, then it'll end up as 10,000 to be taxed because it's 30,000.
Yeah, and you got to get the right box. Yep. Because if you check the wrong box and you check it as 59.5 and not state, then he's going to pay tax on 10,000 of his federal pension, which he shouldn't in state.
What happens if you did not check anything in those boxes?
It doesn't carry over.
Nothing carries over.
That's why I say,
Did they give you that little red thing too?
Nope. No, that's why I say you got to know on retirement, out of sight, out of mind. Okay. All right. So when you see a retiree that has a federal refund but owes on the state, first thing I would go back and double check. Did I check my 59.5 box for their pension to exclude that? Okay. All right.
And then he has an exclusion worksheet on that.
Well, that's something we're going to talk about here. Okay. On these exclusion worksheets, if we look at that, see where it says amount rolled over? That may be something like I was talking about, that somebody rolled it over within the 60 days, but it wasn't a trustee to trustee. So our box in box 7 does not say G. All right. So if on this one, this was a G.
Could be a 7G?
No. Okay. So there would not be a taxable amount. So if I go back to my 1040 page 1, see how this little thing, 15,000 is not in my income, and the little box, it says that I was rolled it over. Okay. And that knew that because of the code G that I put in there. All right. Equally, if it was, okay, but this box said 1 because he took it early. It was something that he got as a check from a previous employer he didn't know that he have, but he can justify that within the 60 days that he rolled it over. I can put that, what are we at, 10,000? No, 15. I can put that 15,000 in here, okay? And then if I go to my 1040 page 1, what does it show? It's a rollover. Yep, so it's still rolled over, okay? So, yep, so there's a lot of things on these 1099Rs that flow over to it, okay? Now, if I didn't have that, didn't have this, it might be the case that we need to do the simplified method to decide, you know, things. And the other thing is, see where it says RRB line 3. Yep, so railroad amount, we would use this simplified method. And that's really the only time you're going to use this down here, okay?
You only use it for the railroad one?
Yeah, pretty much anymore. The other stuff is not really in there, so, okay. All right, so we have that, okay? All right, so we got his 1099R, and we kind of talked about some of the other stuff on there. Like I said, the other thing too is state tax. Most of them won't withhold the state tax, okay? All right. Now we flip over to page 9.8. We got a 1099R for Elizabeth, okay? All right. So you can, if you're on the 1099R, you can hit the little white tab up at the top, says copy it. And we got to make sure we check what? First thing. Yep, spouse. Okay. So go ahead and put in the, just like the W-2 information. And this comes from, must be in a company that she worked with prior to her employment with Nutty for You. Okay. Okay, she had some federal tax withheld. And what's this one coded?
1.
Which for you, first thing it's going to think of is what? This is a taxable event.
IRA.
Yeah, and the other thing too is that she probably has a it's an early distribution. She's probably going to have a penalty. A lot of things going on. Yep. Okay. And then what else is on there for her? Okay. And the other thing is she knew this is going to be taxable on the state side because she's not 59.5, so there was some state tax withholding. Okay.
On number 13, you have to state for the 320, then 13, you have a box, but it wouldn't let me start putting in the IT. I have to hit it one more time.
Yep.
What's that little box?
Under the 13, that is NY for New York, so that it carries to your New York.
So you have to put NY there.
Yep. Okay.
Now this already came out as state distribution of the 10,000.
Yeah, once you put the withholding, yeah, it automatically populates for you. Okay.
So now, because she's under the age, I do not hit box 1.
Exactly.
Government, I do not hit box 2.
Yep, and it's not railroad, so you can't do anything there.
Railroad, and 3 is future.
Mm-hmm. So first thing I want you to do with this one, let's go to the 1040 page 1. And when we look at the 1040, we can see how checking that box, see where it put it on the IRA line on the taxable amount on 15B. You should see the 10,000 above the 15.
Yep, taxable amount.
Okay. The other thing is, I want you to go take a look at 1040 page 2 and look at line 59. What does it say there?
Oh, it's $1,000.
Mm-hmm.
Which was what they withheld.
Mm-hmm.
Sure to pay tax on.
Yep.
Where's my penalty?
59, doesn't it say 1,000?
Oh, that's the penalty?
Yep, that's a 10% penalty.
Oh, I get it. That's why they did the federal income tax. They put it as that penalty.
Yep.
Why don't they say slash penalty? Then we know that they did.
The federal tax withheld? Because basically they're doing that withholding, and that's part of the withholding that was on there.
When you go back to 1040 page 1, you
Mm-hmm.
will see the 15,000 that I thought was not going to be taxable.
Mm-hmm.
It's in my pensions and annuities.
Yeah. That distribution from the pension is taxable on the federal.
On the federal, but not on the state.
Exactly. Okay. All right. Now, the other thing I want you to take a look at is if you look on the tree on the left, there's a 5329 form right below your 1099Rs. There's one that says TP for taxpayer. There's one that says spouse. Okay. I want you to.
That one is TP. I just have the one that says SP.
Okay. We'll hit that one, 5329 SP1.
Why don't I have the other one?
It might not have populated because it populated when I was manipulating it. Okay. So, but the 5329 spouse, because why? What's part 1 say? So go to your 5329 page 1, the early distributions. Okay. Now, I'm going to kind of fool with this one just because I want to show you this. All right. So, Elmer and Elizabeth have decided to buy their dream retirement home. Okay. So if I look, early distributions on line 1 that are not subject to additional tax. All right. So I'm going to go in here and I'm going to hit F1. Okay. And I'm going to bring up the little chart that it has here. Okay. And in there is the exception codes. All right. So we were talking about those in the workbook or in the textbook. We talked about the different ones. So I'm going to go down and like I said, Elmer and Elizabeth have decided to buy their dream home. Okay. All right. IRA distributions made for the purchase of a first home up to $10,000. Okay. However, this is what this would be one that we would categorize as generally. Okay. Under the when you get a little bit more into the tax code, and I'm on my form 5329 exceptions to 10% penalties, I am on line says distributions from an IRA to purchase a first home up to $10,000. The $10,000 is a lifetime limit. A first-time home buyer is an individual that has not owned a principal residence for at least 2 years. Okay? If taxpayers are married, both must qualify as first-time home buyers, in which case they may each receive distributions up to $10,000 without the penalty. Okay?
Read that first part again where the 2-year thing.
A first-time home buyer is an individual that has not owned a principal residence for at least 2 years.
So they could have sold their home, lived in an apartment for 2 years, and then they're the first-time homeowner.
Yep. Okay, so I am generally saying that they had rented and decided that that was not for them. Okay, so I'm going to say 09 here, and I'm going to exclude the 10,000. Okay, I could only do 10. In this case, the 10,000 is equal to the 10,000. But if she had withdrawn 12,000, I could still only put in 10,000 because of the exclusion. So what did I just do?
Give her 0, so she's not penalized.
Exactly. So that's where sometimes I will with a client saying, okay, you're under 59.5. This is an early distribution. I'm not trying to pry, but may I ask what you use this for? And they'll say, well, just to pay bills. Okay. And then I would follow up with the reason I asked is there are exclusions to this 10% penalty, but they are very narrow and very specific.
Medical one of them?
Yes, but your medical bills have to exceed 10% of your adjusted gross income. So for them, they would have to have medical bills that they took it out of there would have to exceed $3,600. So say that they had $6,000 in bills, they could only exclude $2,400. Anything that exceeds 10%, not.
So then you can only put 2,400 there, not the whole.
Exactly. Okay. All right. So we're going to take that out of there because we don't want to. Okay. So that's where that comes in with that 5329. Okay. Now on the New York State, we see that the
Page what? 2?
page 2 where the income is. Okay. So we have this, that it was a benefit, was a 10,000 up there on line 9 and 10. We see it just like we do the federal. And we come down, whoops, hold on. Gotta go get Elmer back in there. I took his check off. There we go. Yep, I forgot to put his check back in there when I was fooling with it. So we have on there, her 10,000 shows up there. Okay? All right. So that's how that one worked. Now, we're going to do one more thing here to this one for Elizabeth. She received this as a death benefit. This was from her mother that passed, that had worked for the Harder Company. Okay? So I'm going to put this in as a 4 for a death benefit. Okay? Because she's a beneficiary on it. All right? What did that do to her penalty?
Took it right away.
She didn't have a penalty. Okay?
Because it was on her mother.
Exactly.
Her mother was over 59.
Exactly. So on this one, knowing that mom was over 59 and a half, I can check box 1 because I'm using mom's rules. Yep. And then I can see on here that there's the exclusion. And again, it shows 25 because 10 of it is Elizabeth's from her mother. 15, yep, on that. Okay. All right. See how that works?
So go all the way to the bottom.
All the way to the bottom?
Yeah. And 0.
Yeah, they have no taxable income.
It would have been 20 apiece.
Yep. Okay. So let's take that back and put that as a 1. And we have to take, okay. So now it's a normal distribution, but I'm saying 59 and a half. Okay. See how it's not there because the code overrode the checking of the box. Remember how this is 25? So even though I checked the box for 59 and a half to exclude, that's why the main info is so important that you get the birth date in there right, because they knew she was not 59 and a half, even though I checked that box, it didn't give it to me on the state because of the code. So that's why I say, don't, on sometimes people rush through, and that's why we want you to make sure you do the main info because you got to get it all in there, okay? I know one of the other instructors said she had a little disagreement with somebody that says, well, it's not working out. It's not doing that like you said it would. Well, it's because she was in a hurry and didn't put the birth dates in on the main info. So it had nothing to reference, okay? All right, last part we have on the bottom of 9.8 is the Social Security, okay? So again, I'm a navigator from the 1040. I'm gonna go to my 1040 page 1, and I'm gonna go down there where it says Social Security benefits. And I'm gonna click on that box. I'm gonna hit F9. And it's going to give me a worksheet for Social Security and other income. So we're going to go into that. You got that?
Yep.
Okay. And then if you look there, just as kind of a point that's a little extra income, scholarship income or household employee income if you got no W-2. So that's where you would put that. Okay. We're going to worry about the Social Security here. All right. So Social Security received this year for Elmer was how much? Well, it's a gray box, but it's usually pink. 10,760, right? Okay. What's the next box down there?
The railroad.
The railroad one. Okay. All right. And then we go all the way down. We're going to do Medicare's Part B, C, and D.
We don't do any of the taxes now.
Well, we're going to do the Medicare one first. Okay. So on there you see in the description in box 3, it talks about 1248 was sent to Medicare. Okay, so we're going to put that in, and the reason we put that in, that is a deductible premium. So see where it says that Medicare? All right. What I want you to do is then you have tax withheld $300, right? Okay. All right. Okay. Now, one thing I want you to do, on the tree on the left, you have Schedule A showing up? SCH?
Schedule in detail.
Schedule A above it.
Yep.
Okay.
Schedule A.
Yep. Click on that. Okay. Look at line 1 there under medical expenses. What number is there? So you're on the Schedule A?
Yes, but my one figure doesn't match yours, so I'm just, why yours says 830, mine says 820. Income taxes. Where'd you get that 830?
Taxes withheld. It had, she had 500 and 320. And yours says 820. Did you put in the $10.40 for New York State disability insurance? Okay. And what number do you have?
820.
You put NYSDI on the
So I would
W-2?
find that
On the W-2? Mm-hmm.
So we have the 500, and we have the $10.
And the other for 14, it says NYSDI.
Yep, we have the $10. So that's 500, and the 500 is correct. I mean, it could be my eyes if I'm
Mm-hmm.
you know, the 320 was the
Social Security.
I looked at that, that's wrong.
Well, no, the 300, the 320 was the her pension, the state tax withheld.
That wouldn't make it right.
Yeah.
This would be part of it. So I'm wondering if I did that one.
1099-R for spouse.
I have 320 on it, state tax.
Okay, so it's the $10 from the New York State disability.
That did not add to it.
Yep. On the W-2, on that New York State disability one, you put in New York State disability $10. Do you still have the X checked for qualifies for Form 8880?
Qualifies for form, no, I do not have that check.
Okay.
Check it?
Well, this is kind of a little nuance of the software. What happens with this is that we'll go to your Schedule A,
Okay.
and where it says other taxes.
Yep. General.
So Schedule A, line 8.
Number 8.
Yep. Type in there NYSDI. And then in the box, put 1040.
But why do I have to manually do it?
I'm not sure why yours did it that way. Usually defaults that you have to put it in there. That it, excuse me, that automatically goes in. Yep. Okay. All right. So on the Schedule A up there, but what's your line 1 say?
My line 1 says 1248.
What is that number?
That was.
Your Medicare premium, right? So that's why when we put it in there, we have to make sure we get it off of there so that we have that and it goes to the Medicare premium. Okay. All right.
So
Okay.
if I would have checked that other box on that other thing, for the 8330 or whatever that one was, it would have followed through. And am I supposed to check?
8880?
888.
No, only if you have retirement. Okay.
I'm not going to do that.
You just got to kind of remember to do it when you have New York State disability. When you actually have the software, it'll carry over for you.
Oh, well. Okay.
Yeah.
So I just have a little glitch.
Yep.
Okay, good.
I'm not sure why it's doing that,
That's
but
fine. At least I noticed it.
okay. So we have that. All right. So we have everything on there. All right. Let me make sure because What do you have for your federal refund?
Right now,
Mm-hmm.
I have only 311,
Yep. Okay. What about your state?
601.
Okay. All right. That's what I got. All right. Okay. So those are right on. Okay. All right. So that's kind of the way, and I kind of fiddled around with some of them and did some odd things and such, but that's the way that all those retirement, I tried to do some scenarios for you and everything. Okay. All right. Any questions on that?
Why do you still have the red thing for your W-2?
Because I didn't,
Put something that I shouldn't have, that mine's okay.
I didn't check the withholding box because they felt like
It's a little too low.
yeah, her federal withholding, yeah, like I said, and that's what I use that for. Is it to me, and then I can go look at their federal withholding and see where they're at. So, okay, all right. Okay, so that's Elmer Jones. All right, any questions on that one? Well, like I said, there's a lot going on with those retirement forms. You just got to make sure that you understand where they flow to, especially on the state side, making sure that you got birthdays right and things like that. Okay. All right. Any questions on that? Okay. All right. So. Okay.